A study by Paul Merriman, who is known for his expertise in mutual funds, index funds, and asset allocation, found that a simple four-fund portfolio that contains small cap blend, small cap value, large cap blend, referred to as the S&P 500, and large cap value, when combined over a 92-year period, the portfolio would have averaged an annual return of 11.9% when compared to the S&P 500 that was 10.2%. And not just that, but over a 50-year period between 1970 to 2019, this four-fund portfolio would have averaged a 12.3% annual return when compared to the S&P 500 at 10.6%. That difference means that if you had an initial $100,000 in 1970 with the S&P 500, that would have ended at $15.3 million, whereas with the four-fund portfolio, it would instead be over double that at $32.5 million. Now, before we dive deep into things, if you do find value in this content, all I ask is that you consider hitting the like and subscribe button for future content like this. With that said, the first fund that's included in this portfolio that you probably know about, especially if you follow my content, is the Large Cap Blend, also known as the S&P 500. This index measures the performance of the large cap segment of the US market and is composed of 500 publicly traded US-based companies. And so a few of the investments you could consider here if you're investing on Fidelity is their mutual fund version FXAIX, or if you're on Vanguard, their mutual fund version is VFIAX. But no matter what platform you invest on, you could use ETFs, and for this one, I'm specifically going to go through analysis using Vanguard's S&P 500 ETF with the ticker VOO. And so just to summarize what happens when you buy this ETF, the first thing is that it has an expense ratio of 0.03%. This is the total cost it takes you to own the fund per year, so if you have $10,000 invested, that would cost you $3 per year in fees, which this cost is automatically going to be taken out over time. It's not something you have to pay separately. But in regards to structure for the S&P 500, the median market cap for a company in the fund is estimated to be around $285 billion. And another thing to note is that this fund is market cap weighted, which means the companies that are held in the fund are given weight based on their size. Where we look at the top 10 holdings, you can see Apple is at the top with 7.24% of the entire fund, with Nvidia and Microsoft thereafter at around 6%. And largely due to the big tech companies, the largest market sector in the fund is information technology at 30.7%, with financials, healthcare, and consumer discretionary thereafter. Which, if we look specifically at the returns over the past 10 years, large cap stocks have done very well, with the average returns being 12.93% per year. And if we look at the past 30 years, it has averaged a 10.47% return. And going even further into the data, the average annualized return from 1928 to November 2024 was just over 10%. But knowing that, let's now break down the large cap value index. For this, the Fidelity Mutual Fund is FLCOX, the Vanguard Mutual Fund is VVIAX, and the ETF that I would recommend the most here is the Vanguard Value ETF with the ticker VTV. And so looking at this ETF, you can see that this fund seeks to track the CRSP US Large Cap Value Index, which measures the investment return of large cap value stocks. The fund has a 0.04% expense ratio, so for every $10,000 that you invest, you're paying $4 per year in fees. Which, for those dividend lovers, the fund currently has a 2.25% dividend yield over the trailing 12 months and pays them off on a quarterly basis. And so for the CRSP Large Cap Value Index, the index represents the value style for companies covering the top 85% of cumulative capitalization of the CRSP US Total Market Index. Now, there's currently 333 companies listed, with the weighted median market cap of each company coming out to be $141 billion, and the top 10 companies in the index make up 22.42% of the fund. Which, speaking of, the top ones are Berkshire Hathaway, JP Morgan, Broadcom, ExxonMobil, and United Health Group, each having above 2% weight toward the fund. And knowing that, financials and healthcare have the largest weights toward the fund, being 24% and 16.3%. Which, if we look at the historical returns, the ETF VTV has averaged a 10.44% annual return over the past 10 years, and if we look at the past 30 years, it has averaged a 9.49% annual return. But knowing that, let's now go over the small cap blend index. For this, the Fidelity Mutual Fund is FSSNX, Vanguard's mutual fund is VSMAX, and some of the ETFs that you may want to consider researching on your own consist of Vanguard's VB, iShares IJR, or Charles Schwab's SCHA. But as far as Vanguard's VB, this fund has a 0.05% expense ratio, which is $5 per year in fees for every $10,000 that you invest, which this fund seeks to track the performance of the CRSP Small Cap Index, which measures the return of small cap size stocks. So looking further into the CRSP US Small Cap Index, the index solely targets US companies that fall between the top 85 to 98% of the investable equity market cap, which, as you can see, makes up 1,350 companies, with the weighted median market cap of each company to be roughly $8 billion, and the top 10 holdings combined only make up 3.78% of the entire fund. So the exposure here is very diverse, and the top 10 companies consist of companies you may or may not have heard of, such as Williams-Sonoma or Atmos Energy, all with very low weight toward the fund. And knowing that, the top sectors include industrials at 20.5%, financials at 15.9%, and then technology at 13.6%, which, if we look at the historical returns, the ETF VB has averaged an 8.59% annual return over the past 10 years. But knowing that, let's now go over the last one, that is the Small Cap Value Index. For this, the Fidelity Mutual Fund is FISVX, Vanguard's mutual fund is VSIAX, and some of the ETFs that you may want to also consider researching, just to give you some options, consist of Vanguard's VBR, iShares IJS, or State Street's SLYV. And so the first thing to mention here is that the fund has a 0.07% expense ratio, which is slightly higher at $7 per year in fees for every $10,000 that you invest. The difference is super small, but with this fund, it seeks to track the performance of the CRSP US Small Cap Value Index, which measures the return of small cap valued stocks. So looking further into this Small Cap Value Index through CRSP, the index represents the value style for companies covering 85 to 98% of the cumulative capitalization of the CRSP Total Market Index, which, as you can see, there's 823 companies in the index, with the weighted median market cap of each company to be roughly $7.5 billion, and the top 10 holdings combined only make up 5.95% of the entire fund. And so the top 10 holdings here also contain companies like Williams-Sonoma and Atmos Energy. So after plugging this into the ETF overlap tool, you can see that the small cap VB and small cap value VBR have a 55% overlap by weight from their underlying holdings. And knowing that, the top sectors for this fund include industrials and financials that are both around 22% of weight toward the fund. Which, if we look at the historical returns, the ETF VB has averaged an 8.41% annual return over the past 10 years. But what's really interesting is that since 1972, small cap value has by far performed the best, where it has averaged a 13.47% return. So now that you have a feel for each of these funds, let's now go over a portfolio analysis of Paul Merriman's fund portfolio. So to start it off, using the platform StockRover, which if you want to check it out, you can get a 14-day free trial using the link I have in the description below. But with the portfolio, you can see each of the Vanguard funds and that I have placed 25% of the portfolio to go toward each. And so with this exact portfolio, if we were to compare it to the S&P 500, you can see the biggest differences among the exposure to different market sectors is that the 4-fund portfolio has less technology exposure, but more towards industrials, which you can also see the weight and investment style for each of the categories in the fund, where the 4-fund portfolio definitely provides more diversification, specifically across core and value investments across small and large cap stock, which makes sense. And so knowing that, if we were to look at a Monte Carlo simulation of 1,000 samples going forward, adjusting for inflation, assuming you put $1,000 per month into the portfolio, after 10 years, the average end value is estimated to be around $182,000. But the mean of all 1,000 samples and the 50th percentile resulted in a lower expected annual return for this 4-fund portfolio than strictly investing into the S&P 500 over the next 10 years. Of course, no one knows what the future holds, but let's now look at what history can tell us based on Paul Merriman's research. For starters, he shows that since 1928, the 4-fund portfolio actually outperformed the S&P 500, and even a 2-fund portfolio of solely value stock would have done even better. Not just that, but over a 50-year period from 1970 to 2019, he also shows how the 4-fund portfolio would have also done better. Knowing that, he also shows a table of annual returns based on the percentage of bonds you had within the portfolio, but let's say that you had only stock with the entire 4-fund portfolio mentioned. The time periods with the biggest differences that I noticed that make up a huge reason for why this outcome came up to be is because of the late 70s to early 80s, where the 4-fund portfolio significantly outperformed the S&P 500. Out of curiosity, I plugged all of this into Portfolio Visualizer, which I'll have links to all the tools that I've used in this video in the description below if you're interested to play around. But between that time period, the 4-fund portfolio averaged a 22.22% annual return when compared to the S&P 500 at 14.33%. That is an 8% increase over a 10-year period. And not just that, but if we were to look at small cap value, that index alone averaged a 29.84% annual return over a 10-year period, doubling the performance of the S&P 500. Now, the early 1970s was a tough economic time, largely due to inflation and other factors, where the S&P 500 in the year 1974 declined nearly 30%, and 1973 was down 17%. But the rebound between 1975 to 1979 specifically allowed the S&P 500 to grow 99% in total, where the small cap value rose more than 430%. This article also provided statistics on the returns from the bottom of bear markets since 1926, and because we're talking about index funds that track a broad market, I'm more so looking at the average, where it shows the performance of small cap value shortly after the bottom of a market significantly outperforms the S&P 500. Although by no means am I a financial advisor, nor should you make any financial decisions because of me, you have to do your own research. But I do believe the data presented is very interesting, and besides the fact of market uncertainty, because no one knows what the future holds, I personally am invested for the long term and believe that owning a small percentage of small cap stock, on top of large cap stock being the foundation to a portfolio, that it can be very valuable to diversify and have the ability to average out solid returns over many years. Of course, you can adjust however you like, but a quote I like to refer back to here is from one of my favorite investors of all time, Ray Dalio, who said, "The most important thing you can have is a good strategic asset allocation mix, a portfolio that does well in different environments, because we don't know that we're going to win. We have to have diversified bets." Largely because of this, my recent video covers what I believe to be the 4 best Vanguard ETFs to own for life that have all performed well in different environments, and is why I highly recommend checking it out, which I'll have linked in the description below, right next to some of my other relevant videos that you may greatly benefit from. I'll also have a direct link to my free index fund cheat sheet and guide on how to build an investment portfolio, which also contains a spreadsheet to many different portfolios such as this one that you could learn from. Which, if you want to see exactly how I allocate each of my investments and other exclusive content, consider checking out my Patreon, linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.